On the latest Masters in Business podcast, wow, Jose Minaya runs wealth management services at BNY, Bank of New York. Incredible bank, incredible history. They're literally the first bank. BNY is the first bank in America, the first publicly listed stock on the New York Stock Exchange. Not only do they have $2.2 trillion in assets, but they touch about $1 out of every $5 in assets globally. They touch, $60-70 trillion worth of assets, whether it's through their clearing, their infrastructure, their custodianship. They're just a massive bank, the oldest bank in America, the first bank in America formed by Alexander Hamilton. Jose has a fascinating background and a fascinating career as both a chief investment officer and CEO. Few people are better positioned to talk about not only what's happening in the state of wealth management in the U.S. and globally, but what's coming next, what digital technology and tokenization means for asset managers, as well as the impact of AI on how we're all going to deal with our dollars. I thought this conversation was absolutely fascinating, and I think you will also. With no further ado, my Masters in Business interview of BNY's Jose Minaya. Welcome to Bloomberg.
Hey, good to be here. Thank you for having me.
So let's start out talking about your background. Bachelor's in Finance from Manhattan College, an MBA from Tuck Business School at Dartmouth. What was the career plan?
My career plan was always a work in progress. I always say I almost had like a little bit of a Forrest Gump approach to starting my career. I'm a first-generation American, so I grew up in Washington Heights to a Dominican family, Dominican parents. So baseball was big in my life, and for a while there, I thought I was going to be a pro baseball player.
What'd you play?
I was a pitcher. Did pretty well up until the point that I didn't. And then
high school or college?
High school and college. Yeah.
I pitched in high school. No curveball. That's the end of your pitching career.
Yeah. My whole thing is if I threw strikes, I did pretty well. If I didn't, I was going to get in trouble.
So a little control issue? Is that the problem?
Yeah, a little control issues. Yeah.
It's hard to throw both hard and accurately.
Yes, it is. It's like everything else. It's about trying to find the balance, right?
So that's right. So you mentioned you're a first-generation American. How did that affect you? What does that do to your worldview, your work ethic? How does it affect your outlook and career progress?
Look, I think being a first-gen and just kind of my, the neighborhood I grew up, which I often describe to people. If you've been to Chinatown, well, Washington Heights, when I grew up there, was the Dominican version of Chinatown. But look, I mean, I grew up around strong family values. I had a great home life, very privileged that way, strong work ethic coming in. But I did grow up in a bubble, right? So on one end, what I took with me when I exited or left that bubble was work ethic, was kind of really understanding relationships and that. But then when I left that bubble, it was more defined by, okay, I was in different audiences. I was in situations where then more acclimating was kind of more my focus and my goal for early part of my career.
Really, really interesting. You come out of Tuck, you end up being an analyst. Tell us about the early days post grad school.
Yeah, I think post grad school, I was still trying to figure out what I really wanted to do, because if I even go coming out of undergrad, I had a finance degree. I was good at math, and I asked people, what are you supposed to do with this? And people mentioned Wall Street and firms like J.P. Morgan and Goldman Sachs, and I was fortunate enough to get a job at J.P. Morgan. Everyone was taking a GMAT. I had no idea what a GMAT was, but I figured I'm supposed to take it as well, and I went to grad school. And then coming out of grad school, I went back to Wall Street. Not necessarily thinking that's what I wanted my career to be, but I didn't really have a plan for anything else. I think as I started really searching around what I wanted to do, and instead of advising people, kind of doing things that were going to be there for the long term, build something, I found my way into the buy side, right? And then my first job kind of in investing working at AIG Global Investment Group. I think today it's called PineBridge. But that was my first real investing job. And even there, finding my way, I started out in equities. And I was like, okay, I like this. But I felt like, the other side, as I ran into people on the bond side and private credit, I felt that was more kind of cash flow based versus I used to get annoyed where I felt like my models were right, but the markets never cooperated with, so it didn't matter that I was right. I felt more at home in that environment where it was more around, okay, how do I judge the downside? How do I kind of really analyze cash flows? And then I found myself on the buy side, and I found myself as a private credit manager. I think from there, interesting enough, I said, hey, I found my thing. I love doing this. And I always found myself in situations where I did what I did really well, and somebody always asked me to do a little more. And in that little more, it was always kind of like extending myself and say, okay, am I still the SME, or am I now gathering and doing different things? And then ultimately, especially when I was at TIA, it was this idea of like, oh, should we go into agriculture? Should we go into commodities? And I was like, well, here, I'm a kid from New York City. I don't really know anything about agriculture and commodities. But you know what? I kind of dived in and said, this is interesting. This was the other thing that took me to another place in my career that I'd say I took people view it as a big risk. Because at that point, I was managing about a $15 billion private credit portfolio. Back then, that was a pretty major thing.
Felt like a lot of money.
Felt like a lot of money, and it was and is. And I kind of made a decision from doing these kind of nights and weekends on this project of going into farmland. I made a decision to say, you know what? I'm going to leave all this behind. I want to go try to build this. And even the CIO at the time said, are you sure you want to do this? Because, maybe I'll tell you what. Why don't you give this a run? But you know what? We'll keep your job warm for you here. I think he figured he'll come running back in 6 months.
Give this a run, meaning the CIO position.
Meaning running a farmland fund.
Oh, okay.
Yeah. And I went out and said, oh, I want to do this. We ended up becoming the largest farmland fund institutional manager for farmland assets globally at the time. And, one of the things that my philosophy in doing these things is, taking the confidence to always kind of try things that get me excited and that I feel passionate about. But I think throughout my investing life, one mantra I've always had is, you got to be really good at knowing what you don't know. Mm-hmm. And that comes with being more humble. That comes with kind of asking a lot of questions, not being intimidated by bringing people around you that are smarter than you. Because I was like, hey, I could understand people. I can understand math. Now, how do I fill in these blanks? How do I get people around me that are going to give me kind of the knowledge that I know I don't have? And that career progression was from farmland. They said, hey, wow, you did an amazing job. Can you take real estate? Can you take natural resources? Can you take all of private markets? And then ultimately, can you be the chief investment officer? And then growing that into a asset management firm. And what I realized was that what I thought my passion was in investing. But the real passion that I really found was in building things, managing teams and bringing teams together.
So I want to circle back to building what you did at Nuveen. How do you go from J.P. Morgan to AIG to Merrill? What ultimately leads you to Nuveen?
What leads me to Nuveen is just, I always say, like picking up the breadcrumbs, right? Mm-hmm. I was on a journey of really kind of searching, again, what's my passion, what do I want to do? I was very fortunate, here I am, I'm sitting at a job on Wall Street at J.P. Morgan, very fortunate to have it, but I couldn't see myself doing that job for 20 years. Then I'm like, oh, I'm fortunate to get a job on the buy side. And I'm like, okay, this is great. I'm at AIG. It's a terrific opportunity, terrific firm. Yet there's still that thing that I'm kind of still trying to find that feels like, hey, what's really getting my juices going? And, it was always that search for that thing that kind of made me get up early in the morning. And when I ultimately landed at Nuveen, which was part of TIA, that was that role. And I ended up being there 20 years. And I would tell you the longest role I've ever had in my life, in my entire career, was my 5 years or so as my role as CEO there.
Even 20 years is a long time in the modern world to be at any one firm. It seems people don't do that anymore. What was it that kept you there? It sounds like they kept piling on new challenges and really keeping you engaged.
Yeah, that's exactly right. Meaning, I like the longest role I've had in my career is the 5 years I was the CEO. Part of that, every 3-4 years, someone was giving me something else to build. I always say I get itchy. Maybe I'm not the best steward in the world, but what does get me excited is building things, kind of building new teams. The challenge of kind of like growing a capability. And I got to do that over the course of 20 years. I've been extremely blessed, and same thing in moving to my role now. It's a tremendous opportunity, and I could still say that 20 plus years, I still get excited every morning to kind of go to work.
When you say building new teams, give us an example of some of the sort of teams you helped build that kept you occupied for 20 years.
Sure. I mean, one, I mentioned the farmland example. That was a complete startup from
scratch, from $0.
From $0
Wow.
to kind of go in and building a team. I'm very proud of what we did in private credit. We started the Churchill Group with, again, that was finding the right people, finding Ken Kinsella, who was a tremendous leader, and had a team with him. And we started with zero. Today, that broader platform at Nuveen is almost, call it just short of $100 billion in private credit. So there's multiple examples like that where basically the blueprint was either we were doing an acquisition or we were finding a team, and we're saying, okay, we've got the right makings here of a team. How do we give this team the right tools and go out and try to grow a platform?
So you're no stranger to alternatives. We've talked about farmland, real estate, private credit, private debt, natural resources. What is your view today on alts? What do you think about what kind of feels a little bit like a land rush? What's going on in the world of alts today?
Yeah, and it feels like a land rush, but I will tell you that this has been building for some time. And the interesting thing is, if I go back 10, 15 years ago, my pitch talking to clients around alternatives was one that was largely academic, right? It was this idea of
diversification.
Right. Hey, by the way, I know you haven't seen inflation in 20 years, but it may show up, and if it does, are you protected for it? By the way, you may be going to a market where there's a lot more volatility. Have you thought about that? And then also, hey, have you thought about yield? There's ways to kind of think about principal protection in your portfolio and then yield. And alternatives, I would say it's just a way of bringing in the right correlations into your portfolio. And some of the biggest alpha in alternatives is the lack of access.
Meaning the illiquidity. You can't sell in a panic because the market's off 8%.
Yeah, and in many ways, you're going to kind of structure and get a return you're looking for because you need to have a specific skill or access point to get those assets. So then maybe the markets are a little bit less efficient. The interesting thing is today that academic conversation has turned into urgency, right? So now, while markets have obviously continued to be at all-time highs, I think individual investors have felt what volatility feels like, whether that was coming out of the global financial crisis, whether that was out of COVID and the pandemic. We have felt and seen a lot of significant volatility.
2022, first time in 40 years, stocks and bonds both down double digits. Like, people seem to think volatility gets conquered every few years, and whenever there's any sort of complacency, the market says now's the time to teach people volatility never goes away.
Yeah, and throughout that time period, you've also have seen the growth of index funds, right? So also on top of that is this idea of I always say the world's become more commoditized. When I entered the industry, you differentiated yourself by picking better securities than the next person and driving returns. Then all of a sudden, there was a focus on cost. Believe it or not, once upon a time,
nobody paid any attention.
Nobody paid attention to fees. I think then it was, well, no, you're going to compete on fees as well. And then it became the race to zero. Today, investment performance is obviously extremely important, but it's table stakes. Cost, we're all kind of basically at the bottom end of that curve for cost. So now it's more around what are the outcomes you're going to deliver to someone. Technology it's a big component. It is the flexibility that you offer clients, but it is ultimately about what is the outcomes you're going to get to clients. And that 70-30 portfolio, that passive fund that said, hey, you're in a target date fund, you don't have to do anything, just sit back and it all adjusts and drives kind of the returns you need. Well, in those moments where correlations go to 1, it didn't feel so good.
That's right.
It didn't feel so good. And I think now there's more sophistication in terms of how you package, solutions, more sophistication now on the need to get alternatives to clients. I think these things all now, I think, again, what was an academic conversation today is an urgency.
So the phrase I've heard from a number of people over the past year or so has been 70-30, 60-40, that's the old way. The new way is 50-30-20. Are you in that camp?
Yeah, look, I think 50-30-20, 130-30. Look, at the end of the day, I would say it's not really about whether you should be in the 50 to 30. Ultimately, it starts with a conversation around what are the outcomes you're looking for? What are your needs, right? These markets, and when you think about alternatives, by the way, these are not get-rich-quick schemes. These are not like, oh, my God, we need alternatives because there's like this outsized return. In many cases, I mentioned to you farmland, that was a 4 to 6% return market, but extremely consistent.
And long-time lockups,
and long-term
right?
lockups,
no liquidity.
yeah. And but it gave you a certain correlation. So yes, like all these different mechanisms. At the end of the day, though, what it's really all about is what are the outcomes you're trying to drive for your clients, and what is the sophistication we have and the ability to construct those portfolios. And the most important thing in constructing those portfolios is, do you have access to a broad array of capabilities? Because the more access you have to different types of assets, the better the outcome is. Portfolio theory 101.
So when you were at Nuveen, you ran about $1 trillion in assets. You led the company through a big expansion through the COVID pandemic, and then you helped expand the entire digital engagement. Tell us a little bit about what you put together at Nuveen.
Well, I think, again, at Nuveen, was quite a 20-year journey, because I joined when it was basically just the investment team for TIA.
That was right after the dot-com implosion around 2004, something like that?
That was around 2004. Actually, yeah, I really started in 2005. Mm-hmm. And really, it was just an investment team. Like I said, I joined as a fixed income portfolio manager. At the time, we're managing money for about a $200 billion general account, where everything was based in New York City.
When you say general account, you're managing it on behalf of Nuveen, not specific clients?
I was managing on behalf of the balance sheet of TIA, mm-hmm. which is an insurance company. So largely just that was really the structure. Nuveen, we had not acquired Nuveen yet at that time. But from that $200 billion, you fast forward to today, and what I was there to help build, and it became a $1 trillion asset manager, one where it still managed the approximately $200 billion balance sheet, but then it raised another $800+ billion in just outside capital. And these are sovereign wealth funds, wealth platforms, retail, and it grew to about almost $250 billion in alternatives, mm-hmm. as well. So pretty diversified shop, which now you're seeing a lot of firms trying to kind of capture that same, not just scale, but diversity in their business.
Let's talk a little bit about real assets that you've had a lot of background in. Tell us about real estate, agriculture, timber, infrastructure. Tell us how you built those areas previously at Nuveen, now at BNY.
Sure. And I think, I think first, if you think about those different asset classes, I go back to, these are not typically, strategies that you're trying to get outsized returns. Sometimes they come and they're very much welcomed. They're typically pretty structured transactions, right? Whether it's buildings with rents, farmland with leases, infrastructure with kind of 20, 30-year contracts. Often there is a hedge against inflation, whether that is contractual or just by the nature of the commodity. So
right, prices go up, land goes up, that follows it.
So the simple kind of math on these things are, I'm clipping a coupon, mm-hmm. So there's a yield component, and it's a pretty steady one. I have a gold-like protection, because if you think about what do I own, I own farmland in a particular case. Well, that produces a need for society in perpetuity. So there's a certain kind of protection in your principle in owning that, or wind farms. Just again, there's intrinsic value. Mm-hmm. I have a yield, but it's usually tied to a commodity, and because of that, there's also an inflation hedge component to it, mm-hmm. and it brings down my volatility because it's more of that consistent return profile. So it plays that part in portfolios, that it gives a yield. It gives it in a way that should be pretty kind of high Sharpe ratio, lower volatility. Now, today, that market is it's trying to get into more mainstream. Now, if I fast forward to my opportunity going to BNY, now, look, I had that journey in my previous life. What I saw in BNY is where the industry is going, right? BNY obviously is 2 times the size of where I came from, but it's also part of BNY the bank. And BNY the bank touches about a fifth of the world's investable assets. So there's almost 60.
That's amazing.
Yeah, there's almost $60 trillion, call it 55, 56 trillion to be exact, that the bank is touching. And it's either managing these assets, it's either custodying these assets, or it's helping move kind of the global financial markets around. That is tremendous kind of access points to someone like me sitting as an asset manager, because I'm working at a firm that is one of the largest asset servicers in the world. It also is one of the largest servicers to wealth platforms, i.e. registered investment advisors. Well, I have a wealth platform. I manage an investment platform. How do I get advantage of the fact that there's tremendous technology being invested to help serve asset managers? And if I go back to a comment that we talked about previously, which is, if the world's becoming more commoditized with performance and cost, then what is the difference? The difference in what is the tip of the spear is technology. You hear about tokenized assets, which BNY is on the forefront. That's just about helping clients move money quicker.
Define what tokenized assets mean when we're talking about stocks or bonds.
I think the simplest way that I think about tokenized assets is it's an ability to, again, be more liquid, meaning if you were in a T+1 scenario, do you have the ability to be in a T+5 minutes scenario?
So for the layperson, T+1 means you sell something today, it clears tomorrow, the cash is in your account 1 day later. T+0, as some people call it, means you sell it and you instantly get the cash. Is that what tokenization does for people?
That's a big component. So that's creating that liquidity where if you had to wait 24 hours, now you can wait a lot less than 24 hours. The other thing that it helps do is also kind of you're able to earn a yield on...
Because you're getting the cash. Now, for most people, 1 day doesn't matter, but scale that up to an institution, scale that up to a bank or an insurer, that day times thousands and thousands of accounts and transactions really adds up, doesn't it?
I mean, scale that to, again, BNY is kind of touching and helping move $55 trillion.
So T+0 or T+5 minutes, that's much better than T+1.
And it's a big difference. And your ability, again, to potentially earn a yield in that process also, right? In that whole T+1, in that 24 hours, in many cases, you're not able to earn a yield while that money is clearing.
So back in the bad old days when it was T+3, we were always told, hey, it takes 3 days to just make sure there's no fraud, the right stock is going to the right buyer, the money goes to the right account. And when they got shrunk down to 1 day, well, technology has allowed us to do this, but we still need a day just to verify everything. What is it that allows us to go to T+0? Is it just technology? Tell us how that works.
Yeah, look, I think obviously the blockchain technology is one component. The other component is the fact that one of the reasons BNY can lead in this area is that it custodies around 80+% of the digital assets.
Digital assets, meaning Ethereum, Bitcoin, any other sort of things like that. And
it's it is the largest custodian in the world in general. So clearing something becomes a lot easier when it's all sitting inside. I mean, think about a warehouse. If I don't have to move it from one warehouse to the other, that makes life a lot easier. So
goes from one. You're not even moving it from one row to another. You're just changing the label. Here's who owns this.
Yeah. Now, and again, I will tell you, for me, it's. I was having a conversation with our CEO about this the other day, where I'm like, one of the other things I love about my career right now. Look, it's been a long time since I've walked into rooms and I'm learning something. Because typically, I was a subject matter expert, and typically most rooms that I walked into, I felt like I was the expert in that category. I'm not an expert on tokenization. I'm not an expert on custody. I work at a firm that that has experts, and you're quickly learning. And what's important there, I go back to, hey, but what I do understand, even though I know what I don't know, is this matters to my clients. So all of a sudden, if I am trying to think about, hey, how am I pitching my services to clients in Asia and around the globe, and I have a differentiating factor, meaning I can help you go to T+0. That is a differentiator from a relationship perspective, and this is what I mean by where today there's so much more consolidation in the asset management industry because scale is important. And why is scale important? Because you then need to be able to service and invest in these technologies to service your client. AI is a big topic today, and I would argue and say, well, if it's no longer debatable that AI is here and it's going to be disruptive, it's going to make a difference. So if you believe that, you also have to believe that the firms who can invest in it are going to be the winners for tomorrow. Now, being able to invest hundreds of millions of dollars in AI, that takes significant scale. That takes kind of diversified businesses. Being able to hire engineers, right? So when I was sitting usually in the role of running an asset management shop, it's very hard for me to even say, how am I even going to attract engineers from Silicon Valley? How am I going to be able to pay them? Well, BNY is a massive tech stack, right? Like they can attract a lot of engineers. They can attract a lot of investment in AI. I just happen to be in that realm, part of that universe, and I'm going to be able to benefit from that technology.
So let me step back a second, because we're all guilty of using acronyms, and even something like BNY, you and I understand it, but perhaps the listener needs to learn a little more. BNY is Bank of New York. It's been around for how long?
240 plus years. I think we're at 241 now.
So more than almost 2.5 centuries, more than 2 centuries.
Well, I got to add to because I'm always fat. I will tell you, even as I joined BNY, there were things I did not know. Obviously, it's the first bank in the United States. It was the first bank to issue the first loan or warrant.
Begun by?
Alexander Hamilton. It's the first company traded on the New York Stock Exchange. It was
Amazing.
the first public company.
Right.
Our first clients of the bank were George Washington and Eliza Hamilton, and so it's just got incredible history.
Unbelievable history. In addition to all that history, BNY is also affiliated through ownership with a lot of really well-known names within finance. Tell us about some of the other divisions that maybe people will be more familiar with those names.
Yeah, and I tell you, I think this has a lot to do with kind of the recent performance you're seeing about the firm, because it's unlocking what we would describe as, BNY is a platform operating, has a platform operating model, meaning it has multiple platforms. Of course, it has an asset manager, and it has a wealth business. As we said, it's got a $2 trillion asset manager. It's got about a $350 billion private bank wealth platform. By the way, it also owns Pershing. And Pershing,
giant clearing shop, and
that captures around almost $3 trillion in advisors capital that it's servicing through a technology and a service platform. It has an asset servicing arm, and that asset servicing is serving both asset managers and asset owners, doing things like custody, fund accounting. It has a treasury component as well. The other interesting thing about BNY is it clears all the treasuries of the United States. So, it's a GSIB. It's a significant bank, and plays an important part in our financial system.
Really, really interesting. So tell me the story of how you moved from Nuveen to your role as global head of BNY Investments. You're doubling the size of the assets you're responsible. How have you approached this change? What sort of challenges did you face?
I think every challenge that's that's really attracted me, including what kept me in my previous role and in the different roles I was in, it was the opportunity for growth. Right, and I think looking at BNY and seeing where I believe the industry is going, just saw a tremendous opportunity of what is a $2 trillion shop, should easily be a $4 trillion shop, right? Wow. And you think about the ecosystem that we play in within BNY, right? As I mentioned, we We manage money for other people as an asset manager. We manage money also as a wealth platform for families and individuals. Yet we also service other wealth advisors through Pershing, but they're also the clients of the firm. I'm an asset manager. A lot of my competitors are clients of BNY as well. So, and then you think about the technology that it takes to do all that and grow that technology stack. I feel like a kid on a candy store for two reasons. One, that's a tremendous amount of infrastructure and capabilities that are there that I should have a home field advantage to. The other thing is that has become a lot easier in my job is, when you touch a fifth of the world's assets, most people are your clients. So having a conversation with potential clients is very easy to do. A lot of what you've seen, the recent success of BNY, and I think you said this earlier, is a collection of a lot of different things that were either acquired or built, is that, but it was also a very siloed organization for a while. The ability of having that cross connection. If I look at a world that AI is going to be important, being able to touch your clients in multiple ways and have broader technology, I am sitting in a spot where in all those platform operating models, I'm two of those, but I'm fitting in pretty well. I'm trying to take the advantage of the other 5 or 6 that are around me. A great example of that is Archer. Archer
That's a digital platform?
It's a technology platform for SMAs, right? So i.e. your ability clients want to be able to, we talked about solutions, your ability to go to an Archer. And by the way, my previous job, Archer, I was a client of Archer.
And SMAs stand for separately managed accounts?
Separately managed accounts. So again, now you go back to technology, meaning you may be able to manage bonds and equities and alternatives or even tax managed solutions. Believe it or not, bringing that together in a package for individuals takes technology.
Of course.
Asset managers, traditionally, they're stock pickers or investors. They're not technology people. So you go to that platform and do that. Now, when I joined BNY, I'm like, okay, this is great. They've acquired Archer. I know that they have a great capability for doing this, and this is a growing market. And already, our wealth platform is a client of Archer before it was even acquired. The asset management arm of BNY was already a client, was acquired. Now, Archer is also free to grow because it services a broader capability. So if you're
it services BNY and BNY clients.
Yeah, and that's important because, again, if you think about this, the model of tomorrow and what scale matters is, one, it's its own business and just kind of providing what Archer does to the broader community. We get an inside view and a home field advantage in getting it ourselves. Typically, if I build my own SMA platform, I have to now worry about how do I feed it to grow it. Other people are feeding it to grow it, and I get the benefit of kind of being attached to it. And I think that connectivity around, hey, everything I do on the asset management side, all those clients at Pershing, they buy that as well. Should we not be engaging with our clients to do more for them? It's like, sure, we're doing clearing for you and custody and offering you technology. We also have asset management. All of them obviously buy asset management as well. So having those connective dots, I think is a tremendous competitive advantage.
So I want to talk a little bit about your role. I want to define it better. At Nuveen, you were CIO, and then you were CEO, 2 distinct positions. Your title is global head of BNY Investments and Wealth. Sounds like a little bit of each. You're building, but you're also helping to direct the investing. Tell us a little bit about your roles and responsibilities in this new position at BNY.
Yeah, I think I look on one end of the spectrum is very similar to my previous role, which is BNY Investments is an asset manager. Obviously it's a much bigger one than the firm I came from, but it's an asset manager, and there, I'm the chief executive for that particular platform. We also have a wealth platform, and very different from asset management. It's more dealing with individuals and advice, but there's also synergies in the business, right? Meaning if you're a wealth advisor, you're talking about how do you create investment products, how do you source them? Well, we have investment products, and how do we make sure those two groups are talking to each other? What's the products that we're creating? If you're an asset manager, a big part of who our clients are wealth advisors. So having a good understanding of kind of what wealth advisors need, it really helps to have a wealth advisor in-house.
Sure.
So I'm managing a larger platform, but at the end of the day, my job is still very similar. It's about picking the right teams and people. We talk about $2 trillion, and I would tell you $2 trillion should go to $4 trillion. We don't own any of that money. At the end of the day, our biggest value set of what we do and have is our people. And obviously the technology that we can offer those folks. But people is kind of really our business, and I've kind of seen my job today really as the chief people officer for how we kind of build teams around this.
So let's talk about who the clients are at BNY. You mentioned RIAs and advisors, my day job, but you also work with institutions, you work with high net worth and family offices, as well as other players in the investing world who are also clients. Sounds like you guys are a little bit of everything to a lot of different people. How do you keep all that running smoothly? How do you keep all those balls in the air?
Yeah, well, look, I think BNY is often described as the bank of banks, right? Because, again, it's kind of that broader provider. And in goes the opportunity set, right? Like, again, you look at the firm, I don't know, the last I looked, the stock was about 106. That's in less than a 3-year span or thereabouts from $40. It makes it one of the best performing kind of financial stocks.
And financials have been kind of lagging the tech sector for a couple of years. They're starting to play a little bit of catch up.
They're playing a little catch up. They're doing better, but I think few are doing better, if any, are doing better than BNY. Some of it goes back to that question you just asked me. Yeah, that there's a lot of these, the way typically these conglomerates or these platforms were typically managed were very siloed. The ability to bring in the technology and the leadership to say, how do we have better connectivity across all our platforms is where the value proposition is. And the market is seeing that, and the market is rewarding that.
So it's funny, earlier we talked about how commoditized so much of the world has become. You're basically saying we need to be an integrated solutions provider and not just have these commoditized silos, which is what exists outside of a mega bank of banks like BNY.
Yeah, so much we used to talk about the concept of selling watches. I think that the world doesn't really. It's hard to sell watches now. People are looking for. They need. Our clients are getting more efficient. They need to scale their operations as well. And it's the idea of like, do I want to work with 150 managers, or am I better off working with 20, 30, or 40? And if I'm going to go from 150 different types of managers, to 20 or 30, how do I pick those 20 or 30? What's going to differentiate that? So I think a lot of that is what's driving the need for scale. It's what's driving the need for consolidation, and it's also driving a lot of innovation.
So you've mentioned technology a couple of times. We've talked about tokenization and a little bit about AI. What are the big technological trends that we can look for over the next couple of years? Where are you thinking about how technology is going to have the biggest impact on asset managers and on investors?
Yeah, it's interesting, and honestly, my narrative has changed. I used to say, look, AI is going to be very disruptive, but I have no idea if it's 5 years from now or 20 years from now. And by the way, that makes it very difficult to invest in it, right? Because it's when are you going to get the returns for it? Clearly now that's come into a lot more clarity, because where AI has begun to already yield returns for firms, and BNY is no different, is on the productivity side, right? I think BNY is one of the first firms to have digital employees. So digital employees that can work on real problems. And that's driving productivity increases. And that's kind of been a large part of the narrative with AI. Now the new narrative is it can also provide value add. So again, as an investor, do you have the capability of, instead of the old way of we're going to look at satellite pictures and see how many cars are on the driver? Well, now AI can actually track devices,
right,
and kind of see where things are coming. AI is able to go through a lot more information and disseminate that information. So I still say that human beings with AI will be better than human beings without AI. I.e., you're still going to need the component for human beings in the mix. But so much of the future is unknown. And by the way, I think that's also the uneasy part that we are today in our markets. Because if you speak to individuals on one end, I can kind of picture and say, the economy is doing great. Earnings are strong. Consumer household balance sheets are strong. Wages are still relatively, strong as well. And there's a strong kind of like very constructive view to putting your money in the markets today, even at these valuations. The other side of that story is, okay, but then are we losing the independence of the Fed? Are there geopolitical issues and wars out there that can also, cause massive disruptions in the global economy? Policy issues, and fiscal issues coming to the forefront that could just be mistakes that happen. So at the same time, there's so many things then that can go wrong, right? I would say we're probably at a all-time high of things that can go wrong, yet where you sit today should feel pretty good in terms of, the economics and the economy. And I think technology is the same thing. It's like, wow, AI is going to be disruptive. What we think AI can do is literally changing every week, every month. And again, that in many ways is exciting. In many ways, it's also extremely unsettling.
To say the very least. Since you brought up the current state of the world, profits are all-time highs, but it seems like risks are at all-time highs. I want to throw two of your own quotes back at you and get your thoughts on it. In the beginning of this year, you said, risk assets are going higher. What led you to that conclusion, and has the year played out as you expected?
Clearly, look, I think there was a little bit, I think I was challenged a little bit on that comment. And remember, I said it right after Liberation Day. So the markets were obviously falling off. Mm-hmm. There was a tremendous amount of concern with the tariffs and what would come. I had two thoughts there. One, understanding that I thought the current administration that we have was about the carrot and the stick. Mm-hmm. And we started out the year with the stick, but you know what? The carrot was going to show up at some point. Mm-hmm. And then two, this other view of, most of us don't have a choice to be risk off, right? Mm-hmm. The idea that being risk off through these different cycles hasn't really paid off. So the one thing we should do is go back and look at the fundamentals. But yes, if you're saying I'm going to just take a correlation of one or just take broad market exposure, it's more than, again, the academic conversation being more of an urgency. If you think about the actual conversation around I'm structured for solutions, for outcomes in my portfolio, then why should you be risk off? You already planned for this, right? I maybe plan to have part of my principal protected. I maybe plan to have certain amounts of yield or uncorrelated assets in my portfolio. So my viewpoint is, again, one, the fundamentals are there to not say exit the market, but two, this should not always be around, should I buy this stock or that stock, or should I go bonds or equities?
Has to be broader.
It has to be broader because, we're not a hedge fund. And a lot of what we do is not about that. It is about driving long-term outcomes.
So another quote of yours that caught my attention was, noise is at all-time highs. I totally agree, but explain your point of view.
Yeah, and I'll explain it both in terms of kind of where we are in our markets, and then also it's also like a personal philosophy. One, this is what I mean by things look very calm, things look very constructive, yet I think my team at the time, and this was back in January, I think there were 26 or 30 different press releases or things that happened that kind of really jolted the markets in some way or caused concern. Mm-hmm. So the list of the things going on, whether it's inflation, whether it's political, the Fed, policy changes, wars, the list.
It's endless.
It's endless. So there's that, I think, is at an all-time high of the things okay, what's the list of what can go wrong? But then, the other thing with noise, and I say this to my kids, I'm still trying to master this, mm-hmm. is that in most cases, 80% of what you hear is just noise.
Right. And already in stock prices.
It's there. It's 20% actually matters. Right. I said to be a good investor, you have to be good at knowing what you don't know. But I also think you also have to be good at taking emotion off the table. you could see a lot. Obviously, we're a pretty divided country politically. I would say, like, don't bring that to your investing, right? So it's more like take the emotion out. Don't let the noise suck you in. Go back, and it's about the fundamentals. It's about what's in front of you. It's about your outcomes.
I love the concept of knowing what you don't know. Let's address that. What are investors not talking about, not thinking about, but should? What topics, assets, geography, policy, data points, whatever? What is not at the forefront of many investors' minds, but maybe is getting overlooked?
You know, and again, this is going to sound very simple, and it's been talked about since the beginning of our markets. It's true diversification. And again, it sounds simple, but it's not, because, the old diversification is that 70-30, 60-40 stocks, bonds. The markets are a lot more complex and sophisticated. Mm-hmm. That idea of having that conversation now around, let's talk about what I'm trying to accomplish. Not, hey, I think large caps are hot now, so I'm going to put you in them. Hey, you see technology stocks, I think technology is going to do really good. That, to me, is what's really being overlooked, is, again, where I know a lot of people sit down with their advisors and they're getting that academic, dissertation on you should be diversified, this is why, this is how. But often the conversation falls right back to, is it large caps, small caps? Is it tech stocks? Is it banks? Is it financials? Like, that's not the right conversation. Even as it alts or publics, it's everything. It's all of that. And it's using technology and solutions and packages to create the right construct for individuals.
Makes a lot of sense to me. I only have you for a couple of more minutes, so let's jump to our speed round, our favorite questions we ask all our guests, starting with, who were your mentors? Who helped shape your career?
I've had so many, and I'll tell you, they started with family members. I've had professors. I've had, the dean of the business school at Manhattan College, I felt like was a mentor to me. I have my previous bosses that I still stay in touch with and try to have lunch and dinner with. So I have many people that I can kind of thank.
That's very nice. Let's talk about books. What are some of your favorites? What are you reading right now? I'm not a fiction guy, so most of what I read is nonfiction. I love I'm the same way.
I love all the Michael Lewis's books. Recently read The Boys in the Boat. So I just love the story about people, and I love reading about books that you see perseverance in human beings. Right now, I'll tell you, I'm not reading anything right now. I'm getting ready to read something, and I'm wondering if it's going to stick. But I've been hearing a lot about the Meditations by Marcus Aurelius.
Oh, sure.
And I made the comment around 80% of things you hear is noise. My understanding is that book has a lot about that in there, of like what you should really spend your time thinking about. So I was that synopsis, and I've heard 2 people now mention it. So I'm getting ready to read that.
Let me bastardize that for you and say, what I took from that was recognize what's in your control, and that's what you focus on. What the Fed's going to do, we can't control. Yep. Don't lose sleep over it.
Yeah.
Accept it. It's going to be what it's going to be, but focus on the things you can control, you can change. Really, it has absolutely stood the test of time.
Yeah.
And if you're a Michael Lewis fan, I'm gonna self-promote his most recent book that just came out, Who is Government? We did a live Masters in Business in April, and I want to say the ratio of me speaking to him was probably 3% to 97%. For 90 minutes, he just regaled the audience with stories and had people in stitches. Absolutely hilarious stories about Billy Beane and Brad Pitt. Tears down people's face.
I'm going to go listen to that.
I'm listening
I'm going to listen. Yeah, absolutely.
If you're a Michael Lewis fan, I think I've interviewed him 10, 12 times. That's my favorite interview. I heard stories I never heard before. His books. Great.
His books ruined all the movies that have come out off of his books, because none of them come close, in my opinion, to the actual book.
So I agree with you. The one that's closest is Moneyball. Is at least listen, The Big Short, I love the book. The movie wasn't bad. The Blind Side, the movie wasn't bad. But Moneyball really captured the moment of the
I
book.
agree. That Moneyball was probably the closest you got to the book.
Yeah, no doubt about that. What about streaming? What are you watching on Netflix or Amazon Prime, or what podcasts are you listening to?
Yeah, it's very similar to kind of the whole nonfiction thing. I'm a big fan of documentaries on Netflix. So there's two things that I'll kind of do on streaming. It's like I was watching The Men Who Built America,
Really?
which is a great documentary. It just, again, it has, the J.P. Morgans of the world, the Carnegies of the world, Rockefellers and Vanderbilts. But what it shows you is the tremendous amount of risk that these individuals took. And it was a very different time in America. But I love the documentaries, and then shows. What'll happen is I don't watch a lot of TV. I will watch sports, but I'll hear things like Breaking Bad. Everyone talked about it. I was like, all of a sudden, I'm watching it 10, 15 years after the fact. And then that led me to say, hey, there's this show, Better Call Saul. So I just went through the whole, not just went, but, I've been going through I went through Breaking Bad and then like Better Call Saul. And so the only way I watch shows now is, well, they came out 5-7 years ago, and now I'll go in and be like, okay, I'll dig in.
So I have two things for you. We saw Mad Men during the pandemic. I never saw a single episode when it was on TV. I'm like, wow, this is amazing TV. And if you're a documentary fan, the Billy Joel documentary on HBO,
Yeah.
we're like 3/4 of the way through it. It's just amazing.
And I'm a big Billy Joel fan. I thought it was, and again, to me, it's just history and people, right? You just kind of love learning about people, and then, especially for me, I'm in awe of people who could do things I can't, right? Like I'm in awe of a Billy Joel when you hear about his process and what he does, and you're like, it's hard not to get inspired by that.
No, absolutely, 100%. Our final two questions: what sort of advice would you give to a recent college grad interested in a career in investing?
The advice I give everybody coming out of school, and, I think they're waiting to hear for some kind of special nugget on how they're going to get ahead doing models or what deals. And I'm like, do the easy things really well. Like I did this intuitively, not knowing how important it was, which was, I came into Wall Street, they're not going to I was fresh out of school. They weren't going to give me a big client. They weren't going to give me a big model. But you know what? If someone said, I need copies, I ran and did copies. I could do that. That I can do. Hey, book a restaurant for a client dinner. Hey, don't worry about it. I got it. So to me, it's like life is never going to be that easy in your career than when you're first out of school. Don't come in day one thinking about how do I start traveling to meet clients and work the big deals. It's like do the little things really, really well. That is how they're going to be able to judge you early on.
Good advice. And our final question: what do you know about the world of investing today you wish you knew 35 or so years ago when you were first starting out?
Yeah, I think it goes back to the when I first started learning those lessons of don't pay attention to the noise, pay attention to what really matters. So earlier on, it's hard not to get emotional about investing. Sometimes it's hard even not to get completely kind of and I watch for this in our PMs. Like PMs can fall in love sometimes, even with companies, stocks, and even management teams. That ability to now say, hey, in all these cases, be objective. Remind yourself, be good at knowing what you don't know. Take emotion off. Focus on what really should matter, not all the noise that's surrounding it.
So interesting. Jose, thank you for being so generous with your time. We have been speaking with Jose Minaya. He's global head of BNY Investments and Wealth, managing $2.2 trillion. If you enjoy this conversation, well, be sure and check out any of the 550 we've done over the past 11 years. You can find those at Bloomberg, iTunes, Spotify, YouTube, or wherever you get your podcasts from. Be sure to check out my new book, How Not to Invest: The Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. How Not to Invest at your favorite bookseller. I would be remiss if I did not thank the crack team that helps put these conversations together each week, and I really mean this. Alexis Noriega and Anna Luke are my producers. Sean Russo is my researcher. Sage Bauman is the head of podcasts at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business, on Bloomberg Radio.